Hi everyone. Now that we've had a chance to look over both the vertical and horizontal analysis for both the income statement and the balance sheet, we're going to look at other financial ratios. So there's four categories of ratios. There's liquidity ratios, debt ratios, asset management ratios, and profitability. So for liquidity ratios, the reason a company wants to make sure that they're liquid or that they have enough cash is to make sure that they are able to cover their short-term obligations, okay, or their current liabilities. This is very important for any short-term lenders, their suppliers, and of course the employees to make sure that they can cover any obligations to their employees, such as payroll payable. This indicates a company's ability to meet short-term obligations, as I said. Debt coverage ratios, they measure the extent to which a business can be financed by debt. Okay, and this, of course, is very important to investors, both shareholders and long-term lenders. Asset management ratios are very important to managers. It shows how effectively the assets of the organization are being utilized in order to generate revenue. And then, of course, profitability is important to everyone, all the stakeholders in the organization, and it indicates management's overall effectiveness and efficiency as measured by return on revenue, return on assets, and return on equity. Okay, so we are going to use Modern Industries as we used in the first video to discuss these ratios, and then we are going to as well look at Eastman Technologies. Okay, so we'll come down here and have a look here. Okay, so when we're talking about liquidity ratios, the debt coverage ratio, asset management ratios, profitability ratios, and then there's also a couple of market value ratios. And as you can see here, there are different ratios within each category, and we will look at the formulas for each of these. First of all, I want to take a step back and have a look at a Modern Industries income statement that we have looked at before. And we're going to look at their balance sheet, which we haven't seen yet. Okay, so if you remember Modern Industries income statement or statement of income, we've got the revenue straight through to the profit for the year. So have a look at this, and if you want to, while I'm going through the videos, maybe you can keep that on the side if you want to have a look at the PowerPoint slides. Okay, and we also have their statement of financial position here. Okay, so let's go down and have a look at each of the calculations. So the first thing we're going to do is look at the current ratio. So the current ratio, as I mentioned, is to give a general indication of the ability of the business to meet its current obligations. So for collateral growth and kind of a cushion as well. You want to make sure that you have enough cash to cover your current assets, plus that cushion to make sure that if anything else comes up, you have enough as well. So our current assets divided by current liabilities gives us our current ratio. So as you can see, and this information here is coming from the balance sheet for Modern Technologies. So the current asset is 400 divided by current liabilities, which is 200. And they have an amount, a ratio of 2 times. So the current assets is 2 times that of the current liabilities. So as I mentioned as well with both the vertical analysis and the horizontal analysis, what makes these ratios even more important And more relevant is when you have something to compare it to. So for example, if we created these ratios not just for the current year, but also for a past year, or if we did it for a competitor or benchmarks for that industry and see how they compare, then that ratio would give us even more information. Okay, so let's have a look here. What they call the quick ratio or the acid test. And they're taking current assets that can easily be converted to cash. So if we go back here to the current one, you can see inventory is included in this one. But for the for the quick ratio, inventory is not. The reason being is because it does take a while to turn inventory into cash. First, you have to sell that inventory, and then it becomes revenue, but of course it becomes accounts receivable. And then once it becomes accounts receivable, then within 30 days, approximately, it will be converted to cash. So because it's not easily converted to cash, they take the inventory amount out for when they calculate the quick ratio. So it's current assets minus inventories divided by current liabilities. So it would be our 250, which was our 400 minus the 150 for the inventory, divided by 200. And that gives us a ratio of 1.25 times. Okay, so debt to total assets is a measure the proportion of all debts provided by lenders to finance all assets. Okay, so how much of our assets are covered by debt? So our debt, of course, is our liabilities. So total liabilities divided by total assets. So that's 800 divided by 1200, which is 67%. Okay, so that's our debt to total assets. We could also do our equity to total assets, okay, because our equity is 400 divided by our total assets, which is 1200, and that would make up 33%. Okay. So, and you can see that ratio right here. Okay, times interest earned. So the purpose of times interest earned is to show the debt paying ability of a business or its capacity to service the finance cost. So what that means is, so if you look at your profit before tax and before you cover your finance cost, how many times are you able to cover the overall finance cost? So you take your profit before tax, which is 160, add back the finance cost. So that's going to give you 235. So your profit before you've covered your tax and before you've covered your finance cost is actually 235,000. And if you divide that by your finance cost of 75,000, what that's saying is that you can cover your finance cost 3.1 times. Okay, so what that's showing is how readily able are you to cover your finance costs that are being created by your debt. Okay, we'll come down here and we're going to skip fixed charges coverage. As you can see here, do not use. Well, we're not going to use that one. But we are going to look at our average collection period. So what that means is the number of days it takes for the business to collect payments from all of their accounts receivable. So what we need to do first is figure out our average sales per day. So we look at our revenue number and divide that by the number of days in the year. And in this case, our 2.5 million divided by 365 days gives us, on average, we have sales of $6,849 per day. Okay, so then we look at our statement of financial position and at our trade receivables, And it's showing that we have 190,000 of trade receivables outstanding. So our customers owe us $190,000. Well, if on average we sell $6,849 per day, if we take the 190,000 divided by the 6,849, that's going to give us the number of days that are outstanding. So our average collection period is 27.7 days. Okay. Inventory turnover. So the inventory that we have on hand, as you know, is 150,000, okay? And the inventory turnover shows how long it takes for inventory to be the amount that we have on hand to sell it. Okay, how many times do we take that whole amount of inventory that we have on hand and sell it in a given year? And as you know, when inventory comes off our financial position or statement of financial position, our balance sheet, it goes to cost of sale. Okay, so as soon as we sell our inventory, it becomes cost of sales. So if we take our cost of sales, which is 1.4 million, divided by our 150,000 inventory that we have on hand, then that's showing us that we have sold the inventory value of 150 9.3 times. So the 150 has come out of inventory and gone into cost and sales 9.3 times. Okay, so we're going to look at the capital asset turnover. So the capital assets, which are our non-current assets, we have a total of 800,000. And we divide that into our revenue number, which is 2.5 million. And this is showing us how we're using our inventory, using our long-term assets, how effectively we're using them to generate revenue. So if it's revenue divided by our non-current assets, then it's saying that those assets have created that value 3.1 times, okay? So it measures how intensively a firm's non-current assets, such as property, plant, and equipment, are working. Okay. So we also have total asset turnover. So of all of our assets that we're using to generate revenue, how many times of the total number of total assets are we generating in revenue? Okay, so it's revenue divided by our total assets. So 2.5 million divided by 1.2 million is 2.1 times. So again, how intensely are we using all of our assets to generate revenue? Okay, and I'm going to end the video here. And we have a few more ratios to cover that I will put in the next video. Thanks, everyone.